Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 9 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled M equals Market Direction. How can you determine it? You can read the original post at samfury.com.
We spend a lot of time talking about individual companies, those exciting stocks, the ones everyone wants to pick correctly.
Yeah, that's the fun part.
It is. But we can't forget about the bigger picture. Where is the overall market heading?
It's like if you're trying to sail a boat, you need to know which way the wind is blowing. You could have the best boat, the best crew, but if you're sailing against the wind, you're going to have a tough time.
And that's where William O'Neill comes in. We're diving into Chapter 9 of his book, How to Make Money in Stocks, and he really hammers home this point, even if you pick great companies, if you get the market direction wrong.
Disaster.
Yeah.
He actually says, and I'm quoting here, failure to correctly analyze general market direction is the single most important factor that keeps most investors from making money in the stock market. Strong words.
Strong words. So we're not just theorizing today, we're getting practical, learning how to read the market like a pro.
Exactly. O'Neill gives us concrete tools, real-world indicators that anyone can use.
Love that. Okay, so first things first, what exactly do we mean by the market? What are we looking at?
Right, so when O'Neill talks about the general market, he's referring to those major indexes, the S&P 500, the NASDAQ, the Dow Jones Industrial Average, the NYSE Composite.
Okay, those big names, the ones we always see flashing on the news.
Exactly. Think of them like barometers of the overall financial climate. They give us a snapshot of how the market as a whole is performing.
So we should be checking these regularly, right?
Oh, absolutely. O'Neill stresses the importance of daily observation. Don't just glance at them once a week. Make it a habit to track their movements every day. And don't just look at the price changes. Pay attention to the volume, too, the number of shares being traded.
Volume. Why is that so important?
Well, volume tells us about the conviction behind those price movements. Is a stock going up on heavy volume or light volume? That can tell us a lot about the strength of the move.
Ah, so it's not just about whether a stock is going up or down, but about the force behind that movement.
Precisely. And O'Neill recommends looking at several indexes, not just relying on one. Think of it like taking multiple readings of a patient's vital signs. You would just check their pulse and call it a day. You want the full picture.
Makes sense. So it's about being thorough, being attentive, being a bit of a market detective. Now, I'm curious about this distinction he makes between bull markets and bear markets. He says there's a telltale sign in how stocks open and close each day.
Yes, it's subtle but powerful.
Yeah.
In a bull market, stocks often have this upward momentum throughout the day. They might open strong and then close even stronger.
But in a bear market...
It's like the energy fizzles out. They might open strong but then close weaker than they started.
Okay, so we're looking for those patterns, those trends, and how stocks are behaving throughout the day. But what's the bigger takeaway here? Why is understanding market direction so crucial for investors?
Well, it's all about managing risk. If we're heading into a bear market, even the best companies are likely to see their stock prices decline.
So even if we pick amazing companies, if the market's going down, we're probably going down with it.
It's like trying to swim upstream. It's a lot harder than going with the flow. Knowing the market direction helps us make smarter decisions about when to buy, when to sell, and when to just sit on the sidelines and wait for a better opportunity.
So it's about protecting our capital, not just chasing those big gains. Now, let's talk about these market cycles that O'Neill is so big on. He believes that markets move in these predictable bull and bear phases, but doesn't that seem a bit simplistic? Markets are chaotic, right?
They're definitely complex.
Yeah.
But there are broader patterns, these cycles of expansion and contraction that have repeated throughout history. And studying those recent cycles can offer clues about where we are in the present. It's like studying weather patterns. There will be seasons, even if you can't predict every single rainstorm.
So there's value in understanding those historical rhythms, but not everything moves in lockstep. Some sectors tend to lag behind in their turns. Can you elaborate on that?
Yes, that's a crucial nuance. Not every industry or sector peaks and troughs at the same time. Some are early leaders, some are laggards. For example, O'Neill points out that capital goods, things like machinery, industrial equipment, often lag behind in their turns.
Why would that be?
Well, these are industries that are tied to large-scale infrastructure projects, which take time to get going. So even when the overall market is booming, those capital goods companies might not see the benefits right away.
It's like a delayed reaction, but that means there could be opportunities there, right?
Exactly. If you're paying attention to these subtle differences in timing, you might be able to spot investments that others are overlooking.
Okay, so let's imagine we've been smart. We've ridden a bull market wave up. We've made some nice profits. What does O'Neill say happens next? I know he has a pretty stark warning for us about what can happen to those gains.
Oh, he does. He reminds us that losses hurt more than gains feel good. To really drive that home, he uses this example. If your portfolio drops by 33%, you need a whopping 50% gain just to get back to even.
Ouch. Okay, so how do we avoid that kind of pain? What's his core strategy for protecting those profits?
It's all about preserving capital. That means cashing out some of those profits from bull markets before the inevitable bear market arrives. It takes discipline, but it can save you from huge setbacks.
And how do we know when to make that move? That seems like the trickiest part.
He gives some pretty clear guidance. At the first sign of a major market reversal, move at least 25% of your portfolio to cash. And do it fast. It's like taking some chips off the table when you're on a winning streak at the casino. You don't want to get greedy and lose it all.
It's that sense of not getting too caught up in the excitement, protecting what you've earned. And then what? Sit on the sidelines for a while?
Exactly. He suggests staying in cash until a new bull market emerges, which could take 6 months, maybe even longer. Patience is key.
So it's taking a strategic pause, reassessing the landscape before jumping back in. Now, he also mentions those stop-loss orders, which can be a bit confusing.
Right? They can be. Stop-loss orders are designed to automatically sell your stock if it drops to a certain price, limiting your losses. But he reminds us that if we need to sell before that stop-loss price is hit, we got to remember to cancel the order. It's a small detail, but under pressure, it's easy to forget.
And those mistakes can be costly. Okay, I'm ready for the scary part now. How do we recognize when the good times are ending? What are those signs of a market top?
O'Neill introduces this concept of distribution, where heavy selling is happening even though the market seems to be going up. It's like a crack in the facade of a seemingly strong building.
So how do we actually spot this? What should we be looking for?
Look for days where the volume is high, lots of trading activity, but the price increase is surprisingly small, maybe even ending the day down. The range between the high and the low price for that day might also be wider than usual.
So it's like the engine is revving, but the car isn't really moving forward.
Perfect analogy. And this isn't a one-day event. You got to watch for this pattern repeating over several days or weeks. That's when you know something fundamental is shifting.
So even amidst seeming strength, there could be this underlying weakness if you know what to look for. But then, even after a market top, O'Neill warns us that there can be these rallies that suck people back in.
Right, those deceptive bounces. They can make you think the bull market is back when it's really just a temporary reprieve.
So how do we know if a rally is the real deal or just a trap?
He gives us a few signals to watch for. One is if the price increases on the third, fourth, or fifth day of the rally, but on lower volume than the previous day, that's a red flag.
So the volume's telling us the enthusiasm isn't really there, even if the price is ticking up a bit. Any other warning signs?
Keep an eye on how much progress the rally is making compared to the previous day. Minimal progress, that's not good. Or if it recovers less than half of the initial drop, that's another sign of weakness.
Okay, so what's the action to take if we see this happening?
O'Neill's advice is clear after that first failed rally. Seriously consider selling more of your stocks. Don't get caught holding the bag when the music stops.
Got it. Now, he also tells us to look beyond the indexes themselves and watch what those leading stocks are doing. Why is that?
Because those leading stocks are often the canaries in the coal mine. If they start acting strangely after a long period of growth, pay attention. Could be a sign that the tide is turning.
But what does acting strangely even look like?
One thing to watch for is the appearance of what he calls faulty bases on the charts. These are wide, loose, and erratic patterns instead of that nice, tight upward trend.
So it's like they're losing their footing, their momentum is faltering, and then there's this thing called a climax top, which sounds pretty dramatic.
It is. A climax top is a sudden, rapid advance after months of steady growth. It's almost like a final burst of energy before everything comes crashing down.
That's a vivid image. And then he has this one final tip that really stuck with me.
The one about the laggards, right?
Yes. He says to watch for laggard stocks suddenly rallying while those leaders are declining. It's like the understudies are taking center stage while the stars are fading away.
It's a classic sign of a market shift.
Okay, so we've talked a lot about market tops. But what about market bottoms? How do we know when it's actually safe to start buying again after a downturn?
O'Neill explains that a typical bear market goes through 3 stages of decline, and each stage is punctuated by rallies that can be really tempting.
I bet. It's so easy to get caught up in that fear of missing out when things start to move up again.
Totally. But his advice is to be patient. Wait for the real bull market to emerge and resist jumping into those mid-bear rallies. It's like waiting for the storm to fully pass before venturing out again.
So how do we identify a rally that actually has legs, that's not just a fake out?
He suggests watching for a major average closing higher after a decline and then monitoring what happens over the next few days.
So it's not just about one day of positive movement, it's about that sustained momentum.
Exactly. And a key factor here is volume. You want to see increasing volume on those up days, ideally before the 7th day of the rally. That shows real buying conviction.
But he also adds a caveat, right? Even in a true rally, it's not going to be a perfectly smooth ride upwards.
Right. There can still be price dips as the market tests those support levels. Those dips can be scary, but they're normal.
So it's not a reason to panic and sell at the first sign of a dip. Now, I know we're going to talk more about picking individual stocks later, but he makes a point here that's important. Even when a bottom seems to be in, we shouldn't just buy anything, right?
Absolutely. He emphasizes sticking to your stock picking criteria. Don't just buy because the market is rising. You still need to find those quality companies.
It's easy to get caught up in the excitement of potential turnaround. Okay, so we've got those primary indicators, but are there any other tools he gives us that can help confirm those signals?
Yes. He talks about secondary indicators, things that can help us fine-tune our analysis. One that I find particularly interesting is the concept of divergence.
Divergence, what's that?
Divergence is when different indexes start moving in opposite directions or at significantly different speeds. It can suggest a shift in momentum, like cracks appearing in a seemingly united front.
So it's like those indexes are starting to tell different stories, and we need to pay attention to those discrepancies.
Exactly. And O'Neill also delves into some fascinating aspects of market psychology. He suggests tracking things like the ratio of call options, which are bullish bets, to put options which are bearish bets.
So we're looking at what the options traders are doing, trying to gauge the overall sentiment.
Right. And he also talks about keeping an eye on what investment advisors are saying. Are they overly optimistic, overly pessimistic? Sometimes contrarian thinking can be valuable.
So don't just follow the herd. Think for yourself. Now, we can't talk about market direction without talking about interest rates. They have such a huge impact.
Absolutely. O'Neill emphasizes the significance of interest rates, especially the ones set by the Federal Reserve. He points out a historical pattern that 3 successive, significant rate hikes by the Fed have often coincided with the beginning of bear markets.
So those rate hikes are a definite yellow flag, a signal to proceed with caution.
Right. And conversely, when the Fed starts cutting rates, that can often signal the end of a bear market.
That makes sense. Wow, we've covered a lot of ground today.
We have. It's clear that O'Neill really wants to empower investors to understand the forces at play in the market.
And that's what I love about his approach. It's not about following some guru blindly. It's about learning how to read the market ourselves and make informed decisions.
Becoming market detectives?
Exactly. So we've talked about understanding overall market direction, but of course that's only part of the equation. We also need to know which stocks to buy and sell within that larger context.
Right. Which companies are going to thrive even in a challenging market. And that's where O'Neill's can slim methodology comes in.
Yeah. I've heard so much about it, but always found it a bit intimidating.
I understand. It's an acronym. And each letter represents a key characteristic that O'Neill found to be common in those stocks that really took off.
So it's like a secret code to unlock those high-growth companies?
Well, no guarantees, but it's a powerful tool. It helps us filter out the noise and focus on companies with that explosive potential.
Okay, I'm ready to decode it. Let's dive into CanSlim.
Let's do it.
Where do we start?
Oh, with C, of course. Current earnings. O'Neill was all about seeing serious recent growth in earnings, ideally 25% or more, compared to the same quarter the year before. He wasn't interested in companies just kind of puttering along. He wanted to see that hockey stick curve upward.
Makes sense. Earnings are the engine, driving a stock's price higher.
Exactly. Now, A is for annual earnings. This is about consistency. Has the company delivered strong earnings growth year after year, not just a one-time wonder?
Right, so it's not just a fluke, one good quarter. They need a track record to show they can keep it up. But how do you know if that growth is truly sustainable? I mean, what are the warning signs that maybe a company's about to stumble?
Ah, you're thinking like a true investor. It's not just about the numbers themselves. O'Neill digs deeper, looks at profit margins. Are they getting bigger or smaller? Is the company gaining market share or losing ground? Are they investing wisely in future growth? Those are the clues that tell us whether the good times are likely to last.
So we're playing detective, going beyond the surface, trying to understand the story behind those numbers.
Exactly. And that leads us to new products, new management, or new highs. This is where we start to sniff out innovation and disruption.
Okay, so this is about looking beyond just the balance sheet, what's happening in the real world.
Precisely. Imagine a hot new product or service that's taking off. Maybe a dynamic new CEO comes in and shakes things up, or a stock that keeps hitting new highs even when the rest of the market is wobbly. Those are signs of a company that's not just riding the wave, but creating the wave.
So we want those companies that are changing the game.
Yes. Now, supply and demand. O'Neill was all about using trading volume as a gauge of institutional interest.
I've always found volume a bit tricky. What are we actually looking for here?
We want to see that volume increasing on days when the price is going up. That suggests that those big institutions, those mutual funds with their teams of analysts, are accumulating shares. They're putting their money where their mouth is.
It's like peeking into the playbook of the smartest players in the game.
Exactly. And now for L, which is pretty straightforward, leader or laggard, O'Neill wasn't interested in companies that were trailing behind. He wanted those front runners.
But how do you tell who's a leader, apart from just having the biggest market share?
Well, market share is part of it, but O'Neill also looked at what's called relative strength, how a stock's doing compared to his peers and to the overall market. Is it consistently outperforming? That's a hallmark of a true leader.
Okay, so not just good, but exceptional. The one setting the pace.
Right. Now, how do we know if other big players agree with our assessment? That's where I comes in, institutional sponsorship. O'Neill wanted to see evidence that leading institutions were holding significant chunks of a company's stock. And finally, we can't forget about M, which brings us full circle market direction. We can pick the most amazing company in the world, but if we buy at the top of a bull market just before everything tanks.
Ouch. Yeah, timing is everything.
It is. We could find the perfect company, but if we're ignoring the market's overall direction, we're setting ourselves up for trouble.
So Can Slim isn't just a checklist, it's about putting all those pieces together.
You got it. It's a way of thinking, a holistic approach. Well, I think we've given our listeners a lot to chew on today. We've explored how to read the market's overall direction, and we've dived into the specifics of stock selection using O'Neill's powerful Can Slim methodology.
It's a lot to absorb, but it's empowering to know that there are tools and frameworks out there that can help us become smarter investors.
Absolutely. And the key is to keep learning, keep practicing, keep that independent thinking cap on.
Great advice. I'm definitely feeling more confident in my ability to navigate the market.
That's what we like to hear.
Well, thanks for joining us on this deep dive, everyone. We'll be back soon with more investing insights and strategies. Until then, happy investing.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.